Hello, watch collectors. Welcome to our YouTube channel. We're 2 weeks into the second half of 2025, which means we're now closer to 2050 than to the year 2000. What do you think the watch market will look like in 2050? Please let us know. Today, let's look at how the secondary watch market has performed in the first half of 2025. We're sharing the 5 things you need to know about the current state of the watch market. All the data in this video comes from WatchCharts, the world's leading secondary watch market research platform. Dive into the data yourself at WatchCharts.com. Takeaway number 1. Prices for 4 key brands are stabilizing, but most are still declining. The first 2 quarters of 2025 had the lowest quarterly rates of decline since the second quarter of 2022, which is when the market correction began. According to our WatchCharts overall market index, secondary prices fell by 0.4% in the first quarter and by 0.3% in the second quarter. This past quarter, especially from April to June, saw the lowest quarterly rate of decline in 13 consecutive quarters. Although this of course still represents a decline, we're seeing signs of stabilization. Having said that though, I remain a bit hesitant to call the recent trends a recovery of the overall market. The past 5 years or so saw unprecedented levels of volatility and speculation on the watch market. While we can safely say now that the watch market is no longer in free fall, which felt like the case at this point 3 years ago in 2022, we still need to see how the trends develop, especially due to the US trade policy and tariff uncertainties. Here you see the performance summary of Swiss watch brands on the secondary market during the second quarter of 2025. Clearly, the vast majority of brands saw their prices decline, specifically 29 out of the 35 brands here. Among them, 25 brands actually saw a decline of more than 1%. This shows another reason why I didn't want to call the market having stabilized or recovered, because while some big brands are probably stable or at least stabilizing, the rest of the market still seems to be struggling just a bit. Speaking of big brands, I hinted earlier that 4 key brands are stabilizing. These brands are Rolex, Patek, Cartier, and Omega, as highlighted here. As they are among the largest by secondary market share, their strong performance had a strong uplifting effect on the overall market. While you can notice that on an absolute level, brands like Tissot and Mido also performed well, their effects on the overall market are quite small compared to Rolex, Patek, Cartier, and Omega. When we look at the year-over-year performance, comparing the current state to mid-2024, the secondary prices for almost all brands have declined. The one exception is Montblanc, but its share in the secondary market is very, very small. Similarly to the quarterly performance, Cartier, Rolex, Omega, and Patek had an uplifting effect on the overall market year-over-year. It might sound cliche at this point to the longtime followers of this channel, but they had an uplifting effect on the overall market because they are most of the overall market. Audemars Piguet notably had a decline worse than these 4 brands, but its performance was far from the worst. The honor goes to the Swatch brand, whose prices have declined by more than 20% since last year, mostly as a result of the Moon's watch hype continuing to die down. Takeaway number 2. More and more watches are trading below retail. A main reason for this is the retail price increases that brands have implemented so far this year, as we focused on in our previous video. With secondary prices mostly falling and retail prices increasing, it is natural to expect that increasingly more watches are trading below retail. Here you can see the value retention estimates for some major Swiss brands. We define value retention as the premium or discount that an in-production watch trades for on the secondary market relative to its retail price. This is obviously an important metric for a watch, a collection, and a brand. Rolex and Patek are still trading above retail, although the premium for Patek has fallen to mid-single digits. For AP, however, the second quarter of 2025 saw the average value retention drop from positive to negative. Notably, Vacheron's value retention fell below minus 40% for the first time last quarter, meaning that the average Vacheron watch trades at about 60% of its retail price on the secondary market. Of course, as you might expect, the overseas collection retains more value than the others. Overall though, Rolex, Patek, and AP clearly retain their values much better than the others. WatchCharts has been calling them the Big 3 due to their dominant secondary market shares and good value retention. We don't base this on the levels of watchmaking. If we did, I would agree on a personal level with the conventional Holy Trinity inclusions and put Vacheron up there instead of Rolex. Take a look at the percentage of in-production models that trade above retail for, well, our Big 3. Over the past 2 years or so, their percentages have been fairly steadily declining. Of course, most of the models that do trade above retail are sports models. In fact, for Patek, a model trades above retail if and only if it is a sports model. That is, all of the models that trade above retail are Nautiluses and Aquanauts, and all Nautiluses and Aquanauts trade above retail. Even though sports models had always traded far better than their dressier counterparts over the past decade, this was the first quarter where that distinction literally decides whether the value retention is positive or negative. As for Audemars Piguet, no Code 1159 model trades above retail, though some offshore models did make the cut. Most of the models that trade above retail are, as you might have expected, Royal Oaks. Takeaway number 3, pre-owned demand remains strong for many brands while retail sales fall. Here is a comparison between the retail market and the secondary market for some major brands when looking at the changing transaction value from 2023 to 2024, where the estimates for retail sales come from our friends at Lux Consult. For all of these brands, we're seeing much higher secondary deltas than their respective retail deltas, implying much stronger secondary performance than the retail market. This includes both high-level brands outside of the big three, such as Vacheron and Lange, as well as mid-level brands such as Cartier, Omega, IWC, and Tudor. This likely means that more and more collectors are buying watches now from these brands on the secondary market as opposed to on the retail market. Speaking of our big three, let's now include them in the graph. The signs reverse for these three brands, meaning that their secondary deltas are actually lower than their retail deltas. This likely can be attributed to the increased secondary market activity of these three brands back in 2023 following the market downturn, but combined, this graph tells us that more and more collectors are turning to the secondary market for brands outside of the big three. While these figures are for 2024, we're seeing that this trend of strong secondary market performance has mostly continued so far in 2025. This graph shows the change in transaction value on the secondary market when we compare the first half of 2025 to the first half of 2024. For most brands, we saw more secondary sales this year than at this point last year. Patek saw a huge jump thanks to a rekindled interest in Aquanauts. AP is a bit concerning since it has continued to dip. Notably, the four brands we focused on earlier, Rolex, Patek, Cartier, and Omega, are all seeing positive deltas. Overall, the secondary market fundamentals are looking pretty solid and relatively healthy. Takeaway number 4. Many used watches are cheaper now than 5 years ago. Here is a 5-year view of our WatchCharts overall market index. I guess this is a reminder that COVID happened more than 5 years ago, which is scary to think about. But July 2020 saw the secondary market prices just beginning to rise until, of course, the spring of 2022 when the market correction began. The secondary watch market is up about 20% over these 5 years. But wait, you might be asking, didn't I just say that watches are now cheaper than 5 years ago? Well, here is where we bring inflation into the picture. Over the same 5-year time period, inflation was a whopping 25% in the US, meaning that $100 5 years ago had the same spending power as $125 now, because everything has gotten a lot more expensive. So in inflation-adjusted terms, watches are indeed cheaper than 5 years ago. Just to put the inflation trajectory into perspective, I've taken the consumer price index inflation figures and calculated the inflation-adjusted WatchCharts overall market index, shown here below the nominal overall market index. As a side note, inflation figures were notoriously high in 2021 and early 2022, coinciding with the growth of the watch market. You have to kind of wonder how many people spend their stimulus checks on watches, which to me can definitely be justified as essential goods. To make sure I include precedents from both sides of the aisle, takeaway number 5 is that the uncertainties associated with the US tariffs and trade policies do and will continue to impact the prices of watches, both on the retail market and on the secondary market. While the pause on the higher quote-unquote reciprocal tariffs was just further extended to August, it is unclear exactly when new higher tariffs would be implemented and to what extent they would be adjusted from the percentages announced back in April. However, the 10% baseline tariff that has been in effect since April has already led to retail price increases, as we touched upon in our previous videos. We expect that higher retail costs will continue to push consumers towards the secondary market and have an uplifting effect on market prices. This may help to accelerate secondary market recovery, though likely at the expense of retail sales. To recap, here are the 5 things you need to know about the current state of the watch market. Number 1, prices for 4 key brands, Rolex, Patek, Cartier, and Omega, are stabilizing, but most are still declining. Number 2, more and more watches are now trading below retail. Number 3, pre-owned demand remains strong for many brands, while retail sales fall. Number 4, many used watches are cheaper today than 5 years ago. Number 5, US tariff uncertainties could continue to impact prices of watches. Before we end the video, I want to have a brief chat with you and share some of my general thoughts about the watch market today. Right now, if you're looking beyond the standard Submariners, Daytonas, or Royal Oaks, if you want to look for the hidden gems, if you want to look for brands, quote-unquote, not as hot as the big 3, you can probably find very good deals right now on the pre-owned market. Given worsening value retention, as we talked about earlier, the secondary market today has very solid value for money for consumers who are willing to do their research and cross-shop, especially if you take inflation into account. For example, let's give Grand Seiko some love since we've been focusing mostly on Swiss brands. The very popular Snowflake SBGA 211, which I actually used to have until I traded it up to a manual SBGK, cost between $4,500 and $5,000 from 2018 all the way till 2022. I don't know how much it retailed for in 2018, but I bought mine for $5,800 in late 2021. Right now, the watch retails for $6,900 in the US, but we estimate the market price to be just around $4,000. That means even when not accounting for inflation, that watch is as cheap as it's ever been on the secondary market against the hefty retail price increase. When you do include inflation, it obviously gets much better because that $4,000 today is worth as much as just $3,200 5 years ago. That is a much better deal than what was available back then. Having said that though, you can afford to be patient. I don't think there will be another period of speculation like in 2021, 2022 anytime soon, where, secondary prices will go to unreasonably high levels. Also, if you're in the US, don't let the fear of the impending tariffs rush you to make watch purchases. Even if they were implemented, there will be plenty of time to react, both on the retail market, because brands won't jack up the prices overnight, or at least we hope so, and on the secondary market, where there's plenty of stock already in the US to go around. The bottom line is, if you buy now, you almost definitely aren't going to be in a position to lose like 30% over a year when you buy a watch, which was the case for those who jumped onto the speculative market in early 2022. Finally, don't ever see watches as investments. This has always been our view and recommendation since before the growth began in 2020, and obviously even more so after the correction started in 2022. Me personally, I can definitely accept losing like 3% every year in order to have a watch I'll enjoy putting on every morning with a smile. The more difficult part might be deciding which watch that would be for you. Which of the takeaways stood out to you? How will the second half of this year be for the watch market? Please let us know down in the comments. If you enjoyed the video today, please like, share, and subscribe to make sure you don't miss our future videos. Check out our website, WatchCharts.com, where you can explore pricing for over 28,000 watches, track market trends, and even monitor your collection's value over time. And if you're looking to buy or sell watches among fellow collectors, head over to our marketplace at marketplace.watchcharts.com. Our last video looked at the retail price increases of most major brands that happened during the first half of the year, so please go check it out. Thank you for watching, and we'll see you next time.